prepare for what's coming. And there are a lot of these institutions, a lot of these hedge funds that are on the wrong side of the trade and maybe are doing whatever they can to get out of it and to reposition. So I wouldn't pay any attention to this volatility. Take a step back, look at the big picture. And I don't mean to and see silver no longer being suppressed by the Western paper game, because there's just not enough physical to back these contracts. And then the physical market takes over on a real price setting mechanism, which I think will ultimately migrate eastward to Dubai or Shanghai or to the BRICS exchange, which they are building right now. Everyone's looking elsewhere now, eating dinner and not paying attention. Your people are, and I am, and you are, but
Gold staged a comeback on Friday after slipping to a two-week low, as investors moved in to buy the dip amid easing trade tensions. With the U.S. non-farm payrolls report due later in the day, attention has shifted to key labor market data. The metal had dropped to its lowest level since mid-April in the prior session, shedding almost 2% this week, its sharpest weekly decline since the end of February. U.S. gold futures climbed 1.3% to reach $3,263. There's been some progress in the tone around tariffs, but market uncertainty remains high. That's why gold is still seen as a safe haven, according to a NZ commodity strategist Soni Kumari, who noted that every dip in price is drawing renewed buying interest. Should gold slide further and near the $3,000 mark, it may trigger a fresh wave of investment demand. Beijing is currently reviewing a proposal from Washington to reopen dialogue on the 145% tariffs implemented by President Donald Trump. However, China's Commerce Ministry warned the U.S. against using pressure tactics or coercion in negotiations. Now, we've queued up some of the top interview moments for you. Before we get to that, don't forget to subscribe, and enable notifications so you're always up to date with our daily coverage.
down to like 29 or whatever it was, and shot right back up and came down, shot right back up. And yeah, we did see pretty dang close to a 200. I mean, it touched it in the middle of the night, 3,500. We're at, like 33, 30 plus right now, up over $40. And that volatility is there for a reason. Volatility keeps people sitting on their hands, not making the decisions. This is a game that is being played at the highest levels of the LBMA and COMEX. This is a game that is being played with sovereign nations and central banks and commercial banks that are trying to, I think, prepare for what's coming. And there are a lot of these institutions, a lot of these hedge funds that are on the wrong side of the trade and maybe are doing whatever they can to get out of it and to reposition. So I wouldn't pay any attention to this volatility. Take a step back, look at the big picture. And I don't mean to underestimate it. A $200 drop is a lot, but $40 move up today is just over 1%. A $100 drop yesterday is 3%. Is that really that big? No, it's not. It's 3%. Yeah, you don't want to see that day in and day out, but it seems like we're going 2 steps forward, 1 to 1.5 steps back, and it keeps going higher, base building. And that volatility, the only time people who choose to look at gold a certain way, the only time they notice it is, oh yeah, it fell by $200. But it's psychological as far as I'm concerned, and it keeps John Q. Public from crossing the Rubicon from traditional assets into things like gold and silver. And I think the people that are controlling the price and ultimately controlling the destiny of where this goes understands that. They want to reposition, but the futures market allows them to paint a narrative that keeps most people, misdirected into other asset classes, and that plays right into the hands of the big money that is quietly repositioning. As I truly do believe we are seeing a reintegration into the monetary system. I truly believe that. It won't be easy, but it will outperform everyone's expectations. When you see it fall like that, don't lose sleep. You'll see it come right back. I would venture to say, who knows what it opens up at tomorrow, but up $41 after falling nearly 100 today, or 80 today. So it fell by 80, it's up 40. So half of the fall today has come back in the aftermarket. No one's paying attention. Everyone's looking elsewhere now, eating dinner and not paying attention. Your people are, and I am, and you are, but don't don't let it get you down. This is something you have to understand as someone who sees the bigger picture. Don't let the bull throw you. That's what they're trying to do. The bull wants to take as few people along for the ride as possible. Doesn't bother me at all. It's annoying, but it shouldn't bother you. It's just part of the game.
Meanwhile, in another key development, Chinese investors made a substantial move by cutting their gold futures positions by 1 million ounces. This drop, one of the largest ever recorded, came shortly after gold briefly climbed above $3,500 an ounce for the first time. This sharp adjustment points to either profit-taking or a strategic shift in risk exposure among major players in the market. Interestingly, this move came on the heels of a major buildup just weeks earlier, on April 22, and Chinese investors had added a record 1.2 million ounces to their gold futures positions, fueling a surge that pushed prices beyond the $3,500 mark. The dramatic reversal in positioning is now raising questions about short-term volatility and could influence upcoming market movements. Analysts are urging traders to keep a close eye on changes in volume and open interest for signs of either a breakout or retracement. This large-scale repositioning in the gold derivatives market has even caused ripples in the cryptocurrency space, with some observers noting indirect impacts across digital assets. The sharp unwind on May 1's now ranks as the third largest reduction in gold futures holdings by Chinese investors. We've got the top highlights from this week's interviews ready for you. But before we play them, make sure you're subscribed and have notifications turned on.
7 to 1 or so in 2011. Ironically, I was fortunate enough to tell people to sell their gold to me and buy silver in 2010. The first podcast I did, YouTube with Big Swear, and it was 85 to 1. The second or third time in human history had been that high. And 7 months later, it was 37 to 1, just below its 200-year average. It's been stuck up in this higher range for the last several years. But, for hundreds of years, it was 16 to 1, thousands of years. And then, for the majority of the last 150 years, it's averaged closer to 42 to 45 to 1 than it has up in the 70s and 80s. And seeing it at this level right now, just, this is rarefied air. Typically, anytime it gets near here, it slingshots down. So yes, I do. When it's coming out of the ground, it's 7 to 1. That has to tell you that at some point these numbers are just flat out uneconomical. It's mathematics. It doesn't work. So yes, I do. But, the old adage, the market can be and stay irrational longer than you can stay solvent, has been prevalent for a while. One of these days we'll wake up and see silver no longer being suppressed by the Western paper game because there's just not enough physical to back these contracts. And then the physical market takes over on a real price setting mechanism, which I think will ultimately migrate eastward to Dubai or Shanghai or to the BRICS exchange, which they are building right now. You will see price setting at a whole different level by the countries who have spent years playing the long game and accumulating, who understand commodities and things like precious metals, and will then you'll see price really reflective of that. And I think the world is tired of the charade that the West has allowed to happen with asset prices, because it's controlled where they can make oil negative $40 a barrel. Really? How the heck does that happen? Well, that's because it's controlled by the futures price. It's the tail wagging the dog, and the futures price has turned into a Anyways, it's turned into a speculative arena rather than one where it's about hedging risk and exposure to those who hold the real commodities. So it'll change. And yes, I do think it will, and probably lower than that. If you said it was single digit, it wouldn't surprise me. Ultimately, it wouldn't. It's coming out of the ground at 7 to 1. Put the ratio at 9 or 10 to 1, and that's logic, and ultimately maybe lower. So yes, I do.
What are your thoughts on Andy Schectman's forecast? Do you think his outlook on gold is right on the money, or are you expecting a different outcome? Are you jumping in, pulling back, or turning to numismatics in this environment? Leave your comments below. We want to hear from everyone stacking, selling, or just watching the space closely. Your feedback matters. Now tap on the next video. It lines up perfectly with what we've covered here. I'll meet you there.